You probably noticed it in your own grocery aisle recently. The sticker shock on a bag of Doritos or a 12-pack of soda.
Oh, definitely. We're all feeling that pinch of inflation at the checkout counter right now.
Right, exactly. But the company actually making those snacks is experiencing a completely different kind of pressure on Wall Street. I mean, you interact with this $186 billion global powerhouse almost every single day.
Yeah, you really can't avoid them.
You can't. But as of this morning, July 27th, 2026, the broader market is pricing this giant like it's, well, a broken toy. Its stock is currently sitting right near a 52-week low.
Which is wild when you think about it, and it creates this really fascinating psychological disconnect.
I mean,
Well, the public stock chart is telling the story of decline and panic,
right.
right? But the people actually running the machine, the ones seeing the supply chain data every morning, are acting out a completely different script.
Yeah, they are using their own cash to buy up shares in this massive, unanimous wave. And that's exactly why we are doing a deep dive on PepsiCo today, because of that massive tug-of-war.
It's a perfect setup for a deep dive.
So just to set the stage, the stock is trading at $136.64, which is just a couple of dollars above its absolute yearly low of $133.73.
Right, at the bottom.
Exactly. So today, our mission is to explore the fundamental catalysts and the market sentiment to figure out what the consensus might be missing here. We're looking at how a legacy consumer company weaponizes its scale against inflation and, how you can spot the hidden signals in their stock.
I love it. And to even begin understanding why the market is so spooked, we first need to understand the architecture of the underlying machine. The sheer scale of PepsiCo often gets misunderstood.
Yeah, because people hear the name and they immediately picture the blue soda can. Yeah.
Exactly. But the reality is that they operate a dual-engine business model. They combine the world's second-largest beverage portfolio, so that's Pepsi, Gatorade, Tropicana, with the absolute largest snack portfolio on the planet in Frito-Lay.
And the numbers on that snack portfolio are just staggering. I mean, they own 23 different brands that each generate over $1 billion in annual retail sales.
23, it's crazy.
Lay's, Doritos, Cheetos, Mountain Dew. Having that level of brand diversification drastically reduces their reliance on any single product.
Right. If consumer tastes shift away from one specific chip, they have 22 other billion-dollar pillars holding up the revenue roof.
Yeah, and it shows in the top-line growth. Even in this brutal macroeconomic environment for consumer staples, their trailing 12-month revenue growth is sitting at 5.62% year over year.
Which is incredibly resilient for a mature mega-cap company. They are definitely not standing still. And a big part of that top-line resilience really comes down to their pricing power, which is reflected in their gross margins of 54.17%.
Okay, wait, so 54.17%. That means for every dollar a customer spends on their products, PepsiCo keeps over 54 cents after the direct costs of making it.
Exactly. More than half of that dollar stays with them after manufacturing.
I have to pause on that 54% gross margin, though, because having popular chips and soda is fantastic in theory.
Mm-hmm.
But when inflation hits, consumers get incredibly price sensitive.
Oh, absolutely. They trade down.
Right. I see a bag of brand name chips pushing $6, and I can easily reach for the $3 store brand generic right next to it. What mechanically stops the consumer from doing that?
That's the million-dollar question.
Because having a popular product means nothing if you can't guarantee people would actually take it off the shelf.
And the defense mechanism there isn't just about, flashy advertising or brand loyalty. It actually comes down to raw logistics. PepsiCo possesses this profound structural advantage called a direct store delivery network, or DSD for short.
Okay, let's break down how that DSD actually functions on the ground. Because standard food distribution is kind of like taking a public bus.
That's a good way to put it, yeah.
Right. A manufacturer ships a pallet of goods to a retailer's massive centralized warehouse, and the product just waits around until the grocery store's employees finally get around to stocking it on the shelves.
Exactly. And PepsiCo's DSD network is like a dedicated Uber for their snacks. They bypass the retailer's warehouse entirely.
Oh, wow. So they just skip the middleman warehouse altogether.
Completely. They operate one of the largest private fleets in the world. Their own trucks, driven by their own employees, go straight to the local grocery stores and convenience stores.
So it's a PepsiCo employee actually walking into the store.
Yes. Those employees physically walk into the store, restock the shelves, arrange the end cap displays, and manage the inventory in real time.
So they essentially control the theater where the movie is shown.
That's exactly it.
They aren't hoping the grocery store employee gives them good placement. They are taking the premium shelf space themselves before the generic competitor even makes it out of the back room.
And that entrenched logistical advantage is nearly impossible for competitors to replicate at scale today. It grants PepsiCo superior shelf dominance and the agility to bundle snack and beverage promotions together on the fly.
Which gives them serious leverage.
Right, so when input costs rise, things like potatoes, aluminum, or diesel fuel, that DSD network gives them the pricing power to pass those costs onto the consumer without suffering a catastrophic loss in sales volume.
Okay, so we have this impenetrable fortress on paper, a dual-engine model, $23 billion brands, and a dedicated logistical network ensuring shelf dominance.
It's a massive moat.
It is. So if that fundamental machinery is so robust, we have to ask why the stock has plummeted over 11% in just the last 13 weeks, massively underperforming the S&P 500. The market is clearly terrified of something.
Well, the market's fears are grounded in some very real near-term headwinds. While those gross margins we discussed are strong, the net margin, which is the actual bottom-line profit left over after paying every single expense, including taxes and overhead, is compressing.
Okay, so the bottom line is shrinking. What's the number?
It currently sits at 10.78%, which is notably below their 5-year historical average of about 11.5 to 12.5%.
Let's look at the mechanics of that compression, because earlier we talked about consumers trading down to cheaper store brands. To prevent that from happening, PepsiCo has to run heavy promotions, right?
Exactly. Think buy one, get one free deals or heavy discounting at the end of the aisle.
And that strategy successfully keeps their sales volume up so the product keeps moving. But it severely cannibalizes the actual profit they make on every individual bag or bottle, which squeezes that final net margin.
Right, and when you couple that promotional spending with lingering input cost inflation, the bottom line just takes a hit. Analysts are certainly adjusting their models because of it.
We're seeing fair value estimates getting slashed, aren't we?
We are, across the board. For instance, Morningstar recently cut their fair value estimate on the stock from $164.86 down to $155.91.
It's a 5.4% reduction.
Yeah, and it points directly to softer confidence in PFNA, which is PepsiCo Foods North America. Frito-Lay is genuinely seeing volume weakness domestically.
Which brings us to the elephant in the grocery aisle, GLP-1 weight loss drugs.
Ah, yes, Ozempic Wegovy, the market's favorite talking point right now.
Exactly. And these aren't just another passing diet fad. They fundamentally alter gastric emptying and neurological craving signals.
Which is a huge deal for a snack company.
It is. Because if the medication literally blocks the dopamine response from eating salty, hyperpalatable snacks, the consumer stops buying Doritos. So I have to ask, is this a permanent structural decline for their core North American snack business? Or is the market overreacting?
Well, the rise of GLP-1s is a paradigm shift, undoubtedly. But you have to ask how much of that fear is already baked into the stock price. I mean, the panic around these drugs peaked in late 2023. It's a known quantity at this point.
So it's not a surprise anymore.
Right. And yes, it might marginally reduce domestic snacking frequency, but PepsiCo is aggressively pivoting their portfolio to feature better-for-you options. Smaller portion sizes, baked alternatives, zero-sugar beverages.
So they're adapting to it.
Exactly. And beyond that, per capita snack consumption in emerging international markets is still a mere fraction of United States levels. That international expansion provides a massive structural runway for growth, regardless of domestic diet trends.
Okay, let's pivot to the balance sheet because they are carrying a significant debt load in a high interest rate environment. Total debt is hovering around $37 to $40 billion.
That's a big number.
It's massive. And a lot of that stems from huge legacy acquisitions, like when they bought Rockstar Energy back in 2020 for nearly $4 billion just to catch up in the energy drink space. Plus, their ongoing aggressive share buyback programs.
Right, which adds up.
So their net debt to EBITDA ratio is currently sitting around 2.5 to 2.8 times.
And just for clarity, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's essentially a measure of their raw, underlying cash profit from core operations.
So what does a ratio of 2.8 times actually mean in plain English?
It basically means it would take them nearly 3 years of that raw operational profit to entirely wipe out their debt. And that figure is slightly above management's own long-term target of 2.5 times.
So rising leverage is a mathematically valid concern, especially when debt becomes more expensive to service.
It is, but the broader context softens that blow significantly. They still maintain pristine A+ and A1 investment-grade credit ratings from the major agencies.
And the reason for that rating is the sheer velocity of their cash generation, right?
Exactly. They produce a monumental $8 to $9 billion in operating cash flow annually, even after they reinvest roughly $4.5 billion back into the business, to build new factories, upgrade trucks, expand operations. They are left with $4 to $4.5 billion in free cash flow.
Wow, so that's pure, unencumbered cash just sitting in the bank.
Yep. Which gives them more than enough liquidity to manage those debt obligations without breaking a sweat.
Okay, so the bear case is coherent. We have net margin compression from promotional warfare, slightly soft North American snack volumes due to changing consumer habits, and a slightly elevated debt ratio. Wall Street is hyper-focusing on these specific risks.
They are, and it's driven the price down.
But when we pull back and look at the internal data, there are flashing green lights, suggesting that Wall Street's sentiment might be fundamentally flawed here.
Oh, totally. The most compelling piece of evidence in this entire analysis is the cluster buying signal.
Yes, I love this part. Break down the cluster buying for us.
Over the last 90 days, the insiders at PepsiCo, the executives and board members have executed 11 open market purchases. They've bought over 6,100 shares with their own personal capital.
And there have been zero offsetting sales, right?
Zero. Their management sentiment and purchase ratio, the MSPR, is a perfect 100.
Which is incredibly rare for a company of this magnitude. When insiders at a $186 billion consumer staples giant uniformly purchase shares near a 52-week low, it broadcasts a very specific message.
It screams that they think the market has it wrong. These executives have unparalleled visibility into forward-looking volumes, global pricing trends, and granular cost curves.
They literally know exactly how much a potato will cost next quarter.
Exactly. They wouldn't be deploying their own money if they believed the core food segment was entering some sort of terminal decline. It signals that management firmly believes the stock is materially undervalued.
And while investors wait for the broader market to realize that undervaluation, they're being compensated heavily. PepsiCo holds the prestigious title of a dividend king.
That's 50 years, right?
Over 50 consecutive years of increasing their dividend payout. Half a century of sustained, growing payouts through recessions, wars, and pandemics. And because the stock price has fallen recently, that dividend yield has mathematically pushed up to roughly 4%.
And that yield provides a historical cushion. When you compare a 4% guaranteed dividend from a legacy giant against the S&P 500, which is currently yielding closer to 1%, the spread is highly attractive.
So investors are essentially being paid a 4% yield just to sit and wait for the fundamental turnaround to manifest in the stock price.
Exactly. And there are actual engines driving that turnaround today. The international business is doing the heavy lifting right now. Segments like Latin America and international beverages are delivering organic revenue growth in the high single to low double digits.
So that international velocity is actively offsetting the sluggish domestic snack sales we highlighted earlier.
Right. It demonstrates that their total addressable market is still expanding. But what really secures their future is how they are evolving their legacy brands domestically.
And Gatorade is the perfect example of this evolution. They recently launched this multi-year research initiative called the Body of Science Study.
This was fascinating to read about.
Instead of just relying on blind market research, they used actual biological data and discovered that 43% of women arrive at their workouts already in a dehydrated state.
Think about that. They identified a massive, scientifically backed, underpenetrated demographic.
It is a brilliant pivot. They aren't just tossing a Gatorade logo onto a football jersey and calling it a marketing campaign anymore. They are using physiological data to engineer new product lines specifically targeting women's hydration needs.
It's evidence-based innovation.
Yes, and it is a formidable way to outmaneuver competitors like Coca-Cola's Body Armor, who just cannot easily replicate decades of ingrained sports science equity. They are expanding the market rather than just fighting for the same piece of the pie.
And that forward-looking brand investment stands in stark contrast to the backward-looking bearish narratives that are currently dragging the stock down.
So we have a depressed valuation, a robust 4% dividend, undeniable insider cluster buying, and scientific brand expansion. But a cheap stock can stay cheap forever if nothing forces it to move.
Very true. You need catalysts.
Right. Let's walk through the catalyst calendar for the next 3 months to see what tangible events could actually shift the market's perspective.
The most immediate catalyst is their Q2 2026 earnings report, which is scheduled for late July or early August. And thanks to all those negative headlines and those fair value cuts we discussed, Wall Street's expectations are incredibly depressed heading into this print.
Which perfectly sets the stage for a classic beat and raise scenario. I mean, if analysts are expecting terrible numbers and PepsiCo delivers just mediocre or slightly okay numbers, it registers as a massive victory.
And if they manage to show even a slight stabilization in those net margins, or if the international growth surprises to the upside, we could witness a violent short covering rally.
Okay, explain short covering for anyone who might not be familiar.
Sure. So when institutional traders bet heavily against a stock by shorting it, and the company suddenly reports positive news, those traders panic. They are forced to quickly buy back the stock to cover their losing positions, which mechanically drives the stock price up in a rapid spike.
Got it. And then literally tomorrow on July 28th, Coca-Cola reports their earnings. Now, my first instinct is to think of them as entirely separate businesses with different internal struggles. But Wall Street models them together, right?
They do, yeah. They are intertwined through what we call proxy momentum. The market treats Coke and Pepsi as the ultimate bellwethers for global consumer health.
So Coke's news is Pepsi's news.
Basically, if Coca-Cola prints a remarkably strong quarter tomorrow, it lifts the sentiment for the entire beverage sector, often pulling PepsiCo's stock up right alongside it.
And what if Coke struggles?
If Coca-Cola struggles, it actually highlights PepsiCo's structural advantage. It reminds the market that Pepsi has a massive snack business to fall back on when beverages slow down.
It's a win-win setup in terms of relative perception. Now, looking a bit further out on the calendar, September presents a massive macroeconomic catalyst, a potential Federal Reserve rate cut.
Yes. And this is where that 4% dividend yield transforms into a really powerful weapon.
Let's trace the mechanics of that for a second, because if the Federal Reserve cuts interest rates, the yield on safe assets like cash savings accounts and treasury bonds automatically drops.
Right. They become less attractive.
Suddenly, institutional investors looking for reliable income pull their money out of those lower-yielding bonds. They look at the market and see a highly stable, cash-generating dividend king like PepsiCo offering a guaranteed 4%. Capital begins flowing rapidly into the stock just to capture that yield.
And that influx of capital triggers multiple expansion. Investors become willing to pay a higher premium for the stock's steady earnings, which drives the valuation multiple up.
And PepsiCo is famously low volatility too, right?
Yeah, exactly. PepsiCo has a beta of just 0.369. Beta measures a stock's volatility compared to the broader market. So a beta well below 1.0 means the stock is significantly less volatile than the S&P 500. In a turbulent economic environment, large funds flock to low beta stocks for safety.
And September also brings a massive wave of seasonal volume. Back to school means millions of households stocking up on lunchbox snacks like Frito-Lay. The start of football and soccer season brings a massive spike in demand for Gatorade and tailgating products.
It's the perfect storm.
And you can bet Gatorade will be heavily deploying that body of science marketing spend precisely as those seasonal shifts happen. Everything converges in the early fall.
You have fundamental seasonal demand colliding perfectly with a potential macroeconomic shift in interest rates, all while the stock is currently priced at a steep discount.
Let's synthesize this whole landscape. We're looking at PepsiCo trading at a severe multi-year valuation discount. The stock currently holds a trailing price-to-earnings, or PE, ratio of 17.85 times.
Which is super low for them.
In simple terms, you are currently paying $17.85 for every $1 of corporate profit the company generates. Historically, investors usually have to pay between $22 and $25 for that exact same dollar of profit.
It's a massive haircut.
You're getting a steep discount, they're paying you a 4% yield to sit and wait, and the executives who know the company best are aggressively buying their own stock. The downside risks margin compression, North American snack fatigue, GLP-1 impacts, and leverage. They are clear and valid, but they appear heavily priced into that 11% decline over the last quarter.
And I think this analysis really highlights why surface-level sentiment can be so deceptive. A stock chart is purely historical, right? It only illustrates what has already happened.
It doesn't tell you tomorrow's news.
Exactly.
Yeah.
Understanding the underlying mechanisms, the logistics of the DSD moat, the velocity of the international growth, and the conviction behind insider cluster buying that gives you a framework for what might happen next. The risk-to-reward asymmetry here is highly compelling.
The downside feels heavily insulated by that valuation floor and the massive dividend, while the upside is primed by rock-bottom expectations and a loaded catalyst calendar.
It's a textbook set up for a rebound.
I want to leave you with a final thought to mull over, something that really stood out from the research today. Think about the implications of that Gatorade body of science initiative. We're witnessing a 20th century legacy company realize that purely relying on nostalgia and a famous logo is no longer a viable survival strategy.
They had to go back to the lab.
They had to utilize actual biological science, discovering that 43% of women arrive at workouts dehydrated just to carve out a new growth vector. So as global demographics shift and our collective understanding of human nutrition deepens, how will other legacy food and beverage titans be forced to fundamentally alter their actual chemical formulas to survive the next 50 years?
That's a fascinating question.
Because if a machine as dominant as PepsiCo has to adapt its core science to keep growing, no brand is safe relying on its past. Keep questioning the consensus, keep looking beneath the charts, and we will catch you on the next deep dive.